I just can't seem to get enough of tax rates. Here we are in video T14E. We're going to revisit tax rates again. First, let's remind ourselves of the overview computation. We're focused on step 5 in this video. We've already discussed that taxpayers over $100,000 use the tax rate schedules, but taxpayers under $100,000, which is most taxpayers, use the tax rate tables. Just as a reminder, here's what the tax rate tables look like, and here's the tax rate schedules. Now, we're largely going to continue to use the tax rate schedules for our examples. We're also going to complicate the tax calculation a bit. Recall that certain characters of income, for example, long-term capital gains and qualified dividends, enjoy preferential rates. We need to weave together the ordinary tax calculation with the preferential tax calculation to see how it works. I'm using 2018 rates, but 2019 and beyond works more or less the same way. Our taxpayer Betty has $87,000 in wages and $13,000 in long-term capital gains. She also takes the $12,000 standard deduction as a single taxpayer. As a result, her taxable income is $88,000. But if we were to apply the typical ordinary tax rates to her taxable income of $88,000, what we'd be missing is that she's eligible for preferential rates on $13,000 of long-term capital gains. So instead, we need to bifurcate the total taxable income into the portion eligible for preferential rates, and then the remainder is just ordinary. Now we can push the $75,000 of ordinary income through the typical tax rate schedules, and we get an ordinary tax of $12,439.50. To determine the tax on the $13,000 of long-term capital gain, we need to examine the separate long-term capital gain and qualified dividend tax rate schedules. And these are, of course, different than the ordinary tax rate schedules. Now, you might think that since long-term capital gain income for Betty is $13,000, and that's well below the $38,600, that Betty's long-term capital gain income would be taxed at zero. However, it doesn't work that way. First, we must consider Betty's ordinary income, which was $75,000. Then we consider the long-term capital gain as the increment from $75,000 to $88,000. As a result, that puts her in the tax bracket between $38,601 and $425,800. As a result, we apply the 15% tax rate. And so $13,000 is multiplied by 15% to get a tax of $1,950. And Betty's total tax is the sum of her ordinary tax and her preferential tax. Now let's contrast Betty with her friend Veronica. Now Veronica's income is much lower. She has wages of only $19,000, but everything else is the same as Betty. Her total taxable income is $20,000. Therefore, we would bifurcate it into its two parts by taking the total, backing out the preferential, and what's left is ordinary. Using the 2018 tax rate tables, Veronica is taxed at 10% on her ordinary income. The capital gains rate is supposed to be preferential, but at 15% for Veronica, that would actually be higher than her ordinary rate. As a result, the tax table contains a 0% rate for capital gains and qualified dividends if she had any. As a result, the tax law permits Veronica to use a 0% rate for her capital gains. So changing gears a little bit, recall that we typically use the marginal rate for tax planning, as it predicts what after-tax cash flows will be with moderate changes in taxable income. However, now that we better understand the integration of AGI and itemized deductions, that might change. Let's look at Archie. So Archie has gross income of $102,500 and itemized deductions of $42,500. That includes $22,500 of a medical expense deduction, and that's after applying the floor for AGI. So he has $30,000 in total medical expenses. If Archie makes an investment and earns an additional $10,000, what is the after-tax effect? Well, if we were to look at Archie's tax rate schedules, he would be clearly in the 22% bracket. So with $10,000 of additional income, we would think that Archie's going to reap $7,800 in after-tax cash flow. Instead, we need to see how that integration of AGI and that additional income changes what happens to Archie. So in the first column, we see the original calculation, taxable income of $60,000 and tax of $91.40. But if instead we look at the additional $10,000 of income, what happens is medical expenses are subject to a higher floor because 7.5% of AGI has increased. As a result, the amount of the medical deduction has decreased by $750. As a result, the tax yields $11,505. And so the increase in tax is $23.65. That's not what we were expecting, because the increase in after-tax cash flows is $26.35, not $7,800. The marginal tax rate shortcut did not work due to the interaction between income and that from AGI deduction that's dependent on the amount of AGI. That brings us to the end of video T14E on tax rates. Again, no guarantees, but this might be our last tax rate video in the course. It's about time. Thanks for watching.